So you've just incorporated your business and now you're wondering, how do business owners get paid? Well, in today's video, I'm going to be answering that very question. Hi, welcome to my channel. My name is Irene and I post videos explaining important accounting concepts using simple language to help business owners gain financial clarity. Make sure you smash that like and subscribe button for more. Business owners can get paid in two ways, either through salaries and/or dividends. So now you're probably wondering, should I pay myself a salary or a dividend? Let me explain the advantages and disadvantages of both methods first. Make sure you stay until the end of the video because at the end, I'm going to be explaining whether either of these methods is going to result in more or less taxes for you. So the first way a business owner can get paid is through salaries. Some of the advantages of paying yourself through the form of salaries is that salaries is considered earned income. And earned income will allow you to generate RRSP contribution room. So if you're somebody who takes advantage of the RRSPs, then this will be an important consideration for you. The second advantage of paying yourself a salary is that income taxes are withheld at source. So what that means is you're prepaying your income taxes off every paycheck, off every salary paycheck. And so when it comes time to file your personal taxes, you would have already prepaid some of that taxes, which will mean that you probably have a smaller tax bill to pay when you file your personal taxes. So this is really important if you're not very good with, let's say, setting aside money, which is a very important skill to have. The next advantage of paying yourself a salary is that when you pay yourself a salary, you have to contribute to the Canadian pension plan, so CPP. And so when you contribute to it, upon retirement, you'll be able to access those funds. Another advantage is proof of income. So if you're in the market right now for a mortgage or a loan or some sort of financing, oftentimes the creditors or the lenders would like to see steady salaries so that they can predict your income so that they will assess whether they want to provide the loan or not for you. Salaries will also allow you to claim the non-refundable Canadian employment tax credit. From the corporation standpoint, the advantages of paying yourself a salary is that salaries are a tax-deductible expense, and so that will help the corporation's taxable income to be lowered and in turn to lower the corporate taxes payable. However, I'm going to be explaining integration later on in this video. So a disadvantage of paying yourself a salary is that now you're going to have increased administrative procedures, and this will likely lead to the increase of administrative costs because now you're probably going to need a payroll provider or a CPA, accountant, or bookkeeper to help you with your source deductions like your CPP, EI, and income taxes that you need to withhold on each paycheck. When you pay out salaries, you also need to file a T4 information return. These are due the end of February of the following year. When you're paying out salaries, you also need to set up a payroll account with CRA. So through your CRA business number, you're going to need to set up an RP account. This can be done all online, so it's pretty straightforward. I would say just setting up the account. It's also very important to note that CRA is very strict on their payroll remittances. CRA imposes hefty penalties for late remittances, and it's very, very important to have very accurate and organized record keeping. Another disadvantage of paying yourself a salary is that now you're going to have to be paying the employer's portion as well as the employee portion of CPP. So some of the disadvantages that I just listed about paying yourself a salary, like setting up payroll, those will not matter if you already have payroll set up and you already have employees. So just adding yourself onto payroll shouldn't be too much of an issue. This is more so considerations for if you have no employees and you're setting it up for the first time. Now let's talk about dividends. So another way that business owners can get paid is through dividends. So assuming you own shares of the corporation and your shares entitle you to receive dividends, some of the advantages of paying yourself a dividend is that it's much simpler. What I mean by that is that you do not need to incur additional administrative costs because you don't need to get a payroll processor or somebody to do the withholding taxes because there is none actually. Dividends are technically draws that you take out from the corporation that will be cleared out or issued out as dividends. If the corporation issues out dividends, the corporation will have to file a T5 information return, which is also due the end of February of the following year. Another advantage of paying yourself a dividend is that when you receive dividends at the personal level, you will also be able to claim dividend tax credits at the personal level. And so dividends can either be eligible dividends and or non-eligible dividends. And each type of dividend has their own preferential tax rate at the personal level. So another consideration is that when you pay out dividends, you don't need to contribute to the Canadian pension plan, so CPP. So some people may look at this as an advantage or disadvantage. Basically, you don't need to pay for the CPP employee or employer portion, but you also won't be able to access those contributions upon retirement because you didn't contribute. So here are some considerations that can be viewed as a disadvantage when paying yourself through dividends. So dividend income is not considered earned income, which means that you won't be able to generate RRSP contribution room. So if all your income that you have personally is through dividends and nothing that's earned, you won't be able to generate additional RRSP contribution room. And if you have no more room left, you won't be able to input money into the tax sheltered account. Another consideration that could be viewed as a disadvantage with dividends is that no taxes are withheld from dividends when you take them out. So what that means is dividends are basically when you're drawing money out of the company. All of those monies that you're drawing throughout the fiscal year, you are basically taking it pre-tax, right? And so once the corporation declares those dividends and files the T5 information return, then you will have to report that on your personal tax return. And so because no taxes were prepaid on that, you will likely be hit with a large tax bill because you got to pay for all the taxes at once. This is before considering installments, okay? So it's really important with this. You will have to set aside money throughout the year or set aside money in order to pay off your taxes. So another disadvantage could be proof of income. Creditors and lenders may want to look at something more stable, and dividend income sometimes isn't viewed as stable because dividend income can fluctuate a lot year to year, whereas salaries are a little bit more consistent. Another consideration that could be viewed as a disadvantage is that dividends are not a tax deductible expense for the corporation. So when you issue out dividends, you will not be able to bring down your corporate taxable income, and this will have no effect on your corporate taxes payable because dividends are basically shareholder draws, so money you take out of the company, so those kind of fall on the balance sheet rather than the income statement. It's not going to affect your taxable income. So you might be wondering which method is going to result in the least amount of taxes for you. Well, without getting into the nitty-gritty of things, our Canadian tax system is structured under a concept called integration. And what that means is that the after-tax cash received by an individual should be the same regardless if it was generated as a salary or paid as a dividend through a corporation. So to summarize, at the corporation's level, you'll pay less corporate taxes when you pay out salaries instead of dividends because, again, salaries are tax deductible for the corporation while dividends are not. However, on the flip side, at the personal level, you're going to be paying less taxes on the same amount of dividends versus salaries because of those dividend tax credits you'll be able to claim personally. Therefore, the effective tax rate under both methods will be the same once all the income has been flown through from the corporation down to yourself personally. At the end of the day, there isn't a right or wrong way to do this or even a one-size-fits-all. I highly suggest you consult a CPA to determine which methods to use to meet your needs and your goals. Because sometimes it could be a mixture of salaries and dividends, or it could be strictly one or the other. If you found today's video helpful, I think you're really going to like this video here. Thank you so much for staying until the end of the video. I'll see you next week.